Hello and welcome to Emerging Trends in Power Project Finance, an overview of the new frontiers and the issues they present. Our webinar today is with Investec USA in partnership with Infocast Events. Today I have with me Ralph Cho, co-head Power and Infrastructure Finance North America from Investec. And we also have Ren Plastina, lead originator, emerging energy technologies, power and infrastructure finance, North America at Investec USA. You can experience at our Infocast upcoming Projects and Money Summit, which is in early January in New Orleans. And Projects and Money is the place where you can get the latest information about the business development outlook and learn what financial alternatives you can turn to. It's your chance to stay ahead of the market and find out what doors are open for business today. We have a lot of great featured speakers, including Ralph Cho, who's our presenter today. And so if you'd like to join us, we hope to see you guys there. We are going to be at the Roosevelt, New Orleans, and rooms are going fast, so please register today at infocastinc.com/event. And before I get started, we also have questions here. So in your control pane, you'll see a questions section, and you can type your questions there in the Q&A box, and we will answer questions if time permits. Thank you guys so much, and now I'd like to welcome Ralph and Ren.
Hey, hello everybody. Thanks for joining the webinar. This is Ren Plastina. I think it'd be useful for us to give a little brief intro on who we are, a little bit of our background, and then we'll pick up the presentation. Here with Ralph Cho. Pass it on to Ralph to do your own intro, and then we'll take it from there.
Great. Thank you. Happy to be a part of this, as Professor Ren is going to give us his view on clean technology and where power markets are supposed to go. My name is Ralph Cho. I'm one of the co-heads of the Power and Infrastructure Finance group here at Investec. I came to Investec 6 years ago and have been here to kind of build a business in this space. I focus more around the capital markets, so anything of who's doing what or what type of financings are getting done and what type of lenders are coming into the market, I can speak pretty freely about. I've been doing this for 20 years or so, so I've done quite a number of these types of financings. Ren?
And so Ren Plastina joined Investec last December to focus on clean tech, emerging energy, infrastructure, just new areas where we feel there's opportunity, which is the topic of discussion this afternoon. So this is taking us through some of the areas that we think are interesting in the market and talking a little bit about some of the issues that will come up because the market is shifting and evolving. And we think, in terms of project finance and the types of solutions that we'll be looking at, they will evolve alongside. So given that we're coming up towards 2019, we thought it'd be a good time for this type of discussion. And in terms of agenda, main goal is to understand how the power market's shifting, take a little bit of a retrospective, then get into some of the project characteristics and risk profiles, what we see emerging on the horizon, and then how does the financing market adapt to the changes?
I think this is a really good and interesting time to be speaking about this topic, just because the power markets are evolving right now. If you think about the liquidity alone, there's just so much appetite for paper, and as lenders are looking to diversify what their portfolios look like, everyone is trying to think about what is the next big thing and where is the activity going to go. And so this is our attempt to give you our crystal ball.
Right, take you on a bit of a journey. So moving on to the next slide, this would be what's happening in the power markets. We've got a graph, right, there we go. This I find is a great summary of where we've been. What we see are a few trends unfolding, and primarily what's most notable on the graph is the swap of between coal and natural gas. This has a variety of different implications, especially in terms of the financing market, which Ralph will cover. But when we take a look at the market shift, and the U.S. has made great strides in terms of reducing CO2 emissions, a good portion of that has been as a result of natural gas replacing coal, and it's about 50%, about a 50% reduction in CO2 profile. So we see that happening. Renewables are growing steadily. That's a big part of the story and will continue to be. So we can see that line growing over time. Also, I highlighted hydro and nuclear just to show how some of the existing infrastructure is pretty stable. There's not much happening in terms of growth, and that'll play into the story with respect to new asset development and gaps that will need to be filled, frankly, as some of these assets are decommissioned.
You know, this slide is super interesting to me because it kind of tells the story of where activity levels have been. I mean, over the last 5 years, just in quasi-merchant gas construction financings, there's been probably over 40, almost 50 assets that I personally have seen, and that represents probably over $35 billion just in debt financing, bank debt financing alone. And so you clearly can see that from this table because you see natural gas growing, and that doesn't even account for the volumes of M&A, right, of gas plants changing hands. Construction financing, especially in PJM, did take a little bit of a breather last year. I guess people were nervous around capacity prices, but with this last capacity price print, forward calendar for construction looks actually pretty good again for gas. I mean, we're aware of at least a dozen opportunities in PJM region by itself. When I look at Investec's portfolio, I mean, we would certainly love to continue to diversify and do more renewables. But if you compare it to the volumes that we're seeing in thermal, like gas, it explains to me why when renewable deals come to market, that the price gets driven down so much, right? Just because everybody wants to do a renewable deal, even if it's merchant. I think they'd be willing to do that.
Yeah. And we'll touch on that a little further in the presentation, but that's definitely a trend that we're seeing. And at this stage, sum it up, nat gas is definitely becoming the transition fuel as far as the generation fleet goes. So if we flip over to the next slide, you can see a little bit of that transition occurring. So the portion on the left, or the pie chart on the left, shows generation by fuel in 2017, and it's largely what we've seen historically as far as resources go, but we have seen that a bit of a shift. Coal at one point would have been about 40–45%. Now it's down to 30. Nat gas is up to 32. That was probably around 25% not long ago. And nuclear and hydro had been fairly steady and stable, and we're starting to see wind and solar come into the market, as well as other resources. So when you shift to the right, you start to see a very different picture. Clearly, natural gas is a massive part of the story, and will continue to be, primarily because there's a lot of it. And as far as baseload capacity goes, it's the one that's most scalable at this point anyway. So that's going to be part of the story. Now we're starting to see offshore wind, onshore wind, solar, a little bit of battery, recip engines, and nat gas. So that variety is shifting, and certainly not much coal, hydro, or nuclear on the horizon. So the market, as a result, we're starting to. There are a few takeaways that we can start to see. Long-term utility PPAs, not as many of those. They're starting to wane, and certainly the natural gas-fired market has not been relying on long-term PPAs. Merchant market exposure will remain and may grow. And then we're starting to see more portfolios of consumer, middle market, and corporate credits. So again, distributed portfolios, different counterparties, and that has ramifications in the market.
Ren, these numbers are funny because I look at the coal, and it's basically, if you believe this, it says 1.2 gigawatts of coal are still being built. Yeah, I haven't heard of any new coal assets being built.
Well, these are planned, so yeah, we'll see if they get done.
Battery, that still seems small.
Yeah,
I mean, we want to finance more battery, and 407 megawatts. I don't know, over the next 10 years or so. That seems a little light. Offshore wind, was that 30 megawatts?
Yeah,
that seems a little light, right?
Right. Those are the official EIA numbers. Now, what we're seeing, though, is a lot of development behind that. So that may not hit the statistics at this point.
True.
But it does outline a point in the sense that the scale right now for a lot of these emerging areas of the market, scale is still small. We're starting to see we're seeing smaller projects out of the gate. And the question is, do you want to get into that? Do you want to get in early on a smaller transaction in order to be ahead of the curve?
Yeah. I like the onshore wind. I know we're back to my diversification points. I mean, we'd even be willing to do merchant wind. I mean, we've seen a number of merchant winds come to market recently. Both Carlisle and BlackRock are in market with merchant wind deals. So maybe this will be a trend.
Yep.
Right.
And on the point of trends, good segue. Next slide, please. So these are some of the trends that we see, and we'll get into some more detail on specifics, but in general, we're starting to see new technologies make their way into the market. The question is, how do we finance those, and what are some of the issues that come up as a result? New applications of existing technologies, which Ralph alluded to in terms of merchant wind and some of the other areas of solar that we will outline. Distributed resources are going to be a bigger part of the mix, and that will flow through. Smarter grid. Technology has definitely evolved to the point where control systems and aggregation of load is becoming more feasible and more efficient. So again, it's an enabler and it's a new trend. Intermittency with renewable resources. One of the big reasons for storage development is to counter the intermittency, but that's certainly part of the program. And then evolving revenue models, which we've alluded to as well. So on to the next slide. And here's the way we see the world in terms of potential market opportunities. Now, moving from left to right, wind and solar is nothing new, but there are new applications that we're seeing and that continue to emerge. Moving through to storage, that's been a big topic of conversation, still fairly early in the game for storage as well. And the transactions, certainly from a project finance perspective, are fairly small, but there is great potential. Distributed gen, not really a technology play, it's more of a business model that we see emerging. The technologies underlying it have been seen for a while and are certainly quite viable. Energy efficiency, that's definitely a technology play, and certainly the ability to achieve efficiencies and aggregate demand response and load are certainly more feasible now than they've ever been. So that's an area to watch. And beyond that, we think mobility has enormous potential, although certainly from a project finance standpoint, it's very early days.
Yeah, I would say, we would certainly look at and evaluate any of these opportunities on this page, right? I mean, we've looked at them. Yep. They're all super interesting. I agree. I think the electric vehicles, definitely, I'm a big believer in the growth of that business. But you're right, all that stuff looks like equity to me, right?
Yeah, it's you're looking at late stage venture, you're looking at early ramp up. So certainly there's a question of economics, there's a question of risk profile.
Sure. Maybe one way we could play right now is maybe some mezzanine lending. I mean, obviously we could always play in equity,
sure,
right? But maybe sprinkle some mezzanine capital around.
Absolutely,
right? We would do that.
And that's a key. We'll get to that later in the presentation, but certainly the mix of financing solutions is going to be broader and certainly more risk associated with some of the earlier stage, and it's certainly an area to focus on.
Yeah, I think what you're saying is if any of these assets can be financed today in some type of structure,
right,
or in some shape or form, right? I agree.
Right. So how long's the horizon? One of the questions we get is, we've been hearing about these types of things for a long time. A lot of the questions around efficiency and storage and distributed assets. Our view is that timeline, that horizon is getting shorter, and we outline the reasons on the bottom right.
Not short enough, right?
Well,
we've been talking about
6 months would be good.
Yeah, we've been talking about this for years. It's coming out.
Exactly. And the good thing about it is that the technology is evolving. It's getting cheaper. It's becoming more efficient. And then the big elephant in the room is that bottom bullet. It's difficult to replicate the existing coal, nuclear, and hydro. So what do? You can build gas, and there's a lot of gas in the pipeline, but do you want to have a grid that's completely dependent on natural gas? And certainly there's room for other resources in the mix.
But just to be clear, we're doing emerging solar now. We're doing emerging wind now. The storage is what we're talking about. It's like on the cusp. and we're doing distributed gen now, right?
Absolutely.
I mean, just
actually,
so we're clear.
we're certainly looking at all of those. The
Yeah.
first four are a big part of it.
It's just a question of where's the supply.
Right. Exactly. Emerging solar. So Investec has done quite a bit of residential solar in particular. I'll hand it over to Ralph to talk about some of the evolution with community solar emerging and CCAs and some of the issues associated.
Yeah, I mean, look, all three of these applications are certainly financeable and are getting financed. Specifically, as it comes to residential solar, it's interesting. It's a question of is this project finance or is this asset-backed finance, like an ABS type of deal? And what we found when we try to go and syndicate these deals is, given the type of collateral that we're talking about, I mean, resi solar is comprised of maybe 40, 50,000 unique home systems on homes, rooftops.
I'm sorry, Ralph, before you go on, can we switch to the next slide?
Resi solar portfolios are comprised of 40 to 50,000 rooftop homes, and you have cash coming in from each homeowner. So your counterparty is a homeowner, not necessarily like a business or utility. And when you layer in on top of these complicated tax equity structures, you really lose the interest of a plain vanilla ABS type of lender, and the project finance lenders gets a little fussed about the nature of the collateral coming from like 40, 50,000 systems. So it does take quite some education. At least from my observation, sounds like it seems to be becoming more mainstream. Pricing has been coming down over the last 3-4 years. Structures are getting more advanced, and people are willing to leverage these assets higher. And so that tells me that's becoming more and more mainstream. But that's basically what you're looking at on resi. On the community solar side, these are also very financeable. I think where you have to get comfortable is it's almost like a one-sided contract, right? These are solar farms that might be located in an area, and they sell the capacity, or they sign PPAs with the local neighborhood. But people move, and they're not going to be held accountable for locking in 20 years under their contract, and the contract gets reassigned to another homeowner. Problem is, as a lender, you're making a forecast that guy stays, and so depending on what type of assumptions you've made, if that guy leaves and the new homeowner signs the community solar contract, power price can be lower that they execute at, and so your cash flows have now changed while you've already, as a lender, put the money out. So you just have to solve for that, and there's been some creative ways that people have structured, but those are definitely financeable assets. On the CCA side, we've done those too. I look at that like a community solar asset, but instead of signing directly with the homeowner, you're signing with like a marketer, an entity that does not have a rating, and that makes it obviously a little bit more complicated for plain vanilla project finance lenders. So you again have to take a view on that area and build in some kind of structural triggers to get a bank comfortable that if you do start to have too many changes of contracts, that you can right size the loan to a place where the banks feel comfortable. But all the issues that get in any of these, you still look at FICO scores, you still look at expected default rates, still have to do due diligence and make sure that you can get comfortable with the different types of contracts, and you still have to look at tax equity. So these are very complicated financings, but again, we are seeing more and more of these types of assets come to market, and lenders getting comfortable, because I see it in the pricing. It's getting painful for us to continue to follow and do. You know what I mean?
Absolutely. Getting certainly a lot more interest in the non-conventional assets for sure. Page 11, please. Go on to the next slide. So this is, we won't spend too much time on this. I think we've covered a lot of it, but just highlighting some of the expected activity, certainly residential, commercial, becoming a bigger part of the story. Utility still there as a baseline. And the idea is that we're going to have to get comfortable with different types of models in order to be able to address the entire market. Moving over to emerging wind, a couple of Major areas where there is new activity, as Ralph outlined, we are seeing quite a bit of offshore generation development. Specific projects are still on the horizon. There are a couple of them. There are plenty more in development and leases that are being made available to developers. So we expect a lot more activity over the next 5 years or so. In terms of well, one of the issues around offshore in particular is that it's been very successful in Europe, but it hasn't been done in large scale in the U.S. Starting to emerge. Many European developers are interested in this market, which is good. There's a lot of experience coming in. We do have issues like the Jones Act that we have to figure out because there isn't a lot of infrastructure to support that build. Now that also opens up opportunities around resources that support the wind development. So we think there's certainly an opportunity there.
Yeah, in the U.S., it's all regulatory, right? I mean, look what happened to Cape Wind. Basically, all these lenders worked on it and were ready to go, and they couldn't get the final approvals to move forward on that. In Europe, yeah, definitely rent is super popular in Europe, and the spreads on the bank debt financings are continuing to tighten to almost like mainstream levels for Europe. And so there's a lot of expert European banks on these structures and the technology that are very comfortable with the risk.
Right.
The question is that going to transfer over to the U.S.? And when we see some players, I think Copenhagen is in the market talking about something like that right now. So let's see. But it's certainly an area I think we should follow.
What do you think about onshore without a PPA and hedged risk, more of a merchant profile?
Yeah, I mean, I think I mentioned earlier. You know, it's funny. I think people are so interested in renewables and looking to diversify their portfolio that I think merchant renewables would get done tighter than merchant gas, and we see it, right? I mentioned that Carlyle's got one in the market, BlackRock's got one in the market. Is this a trend? I mean, let's see. Let's see these two get done. Obviously, if it's going to be done in the bank market, I mean, I think the lenders will take a conservative view of both production and forecasted merchant power price. But certainly, I think it's very doable, and I think there's a strong appetite in the market for these types of deals. We certainly would do it.
No, we're definitely looking at this market very closely, and we're in the middle of some transactions in the space.
The question is price.
Right. Well, there are two ways to look at that, right? On one hand, people that are looking at utility grade credits, high grade credits, they're looking for a little yield, but still want to be in renewables.
That's right.
That's a great trade.
Yeah, it's a good trade.
In terms of portfolio diversity and a little bit of extra yield.
Yeah.
If you're used to gas-fired deals, maybe it's not something that works. So it depends.
One argument a European bank gave me of why he'd rather do like a merchant renewable versus a merchant gas is the power is free.
Right.
So you can't beat free, you know.
Right.
You make something, you know.
Makes sense. And then some of the risks there, you know, we certainly would have to get our heads around basis and price risk, and there are very specific or region specific and site specific aspects to assess, especially if we're looking at merchant. So next slide. Again, this shows a little more context. I think we covered most of the points here. Main areas that we're focusing on are offshore wind development, that's an up and coming space, and also non-utility and merchant wind development and financing. Next slide. Storage. Storage is one of those areas where the conversation is far in excess of the deal flow.
And I would say the liquidity out there available is far in excess of the current level of supply.
So and there's good reason for that. I think I think generally there's a market consensus that storage has a role to play, especially with the growth of renewable assets and intermittency in the grid. And there is enabling legislation, and there are specific initiatives that are being rolled out, which we'll cover on the next slide. So it's certainly a hot area of focus, and there's good reason for it because it will play a role in the grid. As we look at the market, we are primarily focused on lithium ion because that's where we see the most potential, at least in the short term. That doesn't negate flow batteries and hydro and other sources of storage. We think there will be a role to play. At the moment, for reasons that we'll get into, the lithium ion just seems to have the upper hand, and that's where we're seeing a lot of the activity. Within that, there are a variety of revenue models, and I think that's going to be the key. Take your perspective, Ralph, in terms of technology risk. I'm not sure that's the main factor in people's minds, but we can talk about that a little bit.
Yeah, I think lenders can definitely get comfortable with the technology risk. I mean, lithium ion's been around. Obviously, you're still going to have to get comfortable around the warranties behind it, right? Because things do break, right? And someone needs to fix it or pay for it. But it's all going to come down to a revenue model, like you said. I've seen of the few battery storage deals that have been out there, pure play battery storage. You've got a capacity contract or some high grade contract that guarantees a level of cash. Yeah, this is going to go like LIBOR plus 125, crazy price. I mean, we can't lend at LIBOR plus 125. But if your revenue model is something where you rely on ancillary revenues, where it's more of a volatile merchanty type of cash flow where it can go up and down, I think it requires some creative structuring to get you make something financeable, but certainly that's not going to be at a razor thin margins, right? People will want to price that risk, and that's where I think it gets interesting for us.
Yeah, and I think one of the key factors that will be relevant there is getting the market's heads around C&I risk, unrated credits. Again, residential has a role to play there as well. That'll be a large portion of market. The question is, can we come up with a solution that works in terms of credit profile?
I think there's so much hype and excitement over these battery deals that certainly people just to get in are willing to buy them. I mean, and we're no different, Yeah. But I think they'd be willing to go and just buy the deal just to get it done and take the syndication and execution risk off the table.
Yeah. And that just goes to show the scenario, obviously, it's got a lot of potential and people are lining up to get into it.
Yeah.
Next slide, please.
Exciting.
And so this gets into a little reason why. We have specific state energy storage targets and mandates that are being rolled out, and this is all happening real time, certainly more on the horizon, but this gives you an idea of what's already out there in terms of new development. FERC 841 is a major factor. That should allow for battery resources to compete more effectively. And that will be rolling out over the next couple of years. So I think we'll start to see more transparency and new revenue models that the market will be able to get its head around, and that should enable some more development. A key factor is battery costs, and here's where the electric vehicle market and the stationary storage market start to reinforce each other. As capacity grows for EV batteries, the stationary market will benefit as well, and we'll start to see that price curve drop over time. That's where I think some of the alternative technologies other than lithium ion are going to have a tougher time competing, simply because it's cheaper to deploy lithium ion, and also the players that are backing up that technology tend to be larger and provide warranties. So again, that doesn't mean that other technologies don't have a role to play, but for the time being, lithium ion is certainly the short-term choice. And I think we got into a little bit of the technology risk. There are plenty of players looking to come in. The question is, can we finance producers other than the larger producers that can stand behind their product with a strong warranty? Remains to be seen, but as you can see, 160 odd lithium ion suppliers in the market. There are plenty of people looking to get in.
I like this slide because it tells me that there's going to be a lot of activity, right?
Yep.
But let me ask you, at what point do I, as an owner of a gas peaker, get worried?
I think where we sit right now, I wouldn't say that you'd be worried today. But I think over time, in the next 5 years, you should start at least factoring that into your decision. If you're either acquiring or looking to retain an asset, storage is on the horizon. It is a competing resource. It will be. And it certainly has to be factored into the conversation.
Do you think just how coal is getting swapped for gas you think gas peakers get swapped for battery?
Potentially, especially if those prices continue to drop. I think that'll be a major factor. That's a great point. If you look historically and say, would we have seen such a precipitous drop in coal? No one would have predicted that, but here we are. So, and that's primarily because natural gas has become so cheap. So if we can see cheap alternatives, then certainly that's going to be a factor.
Yeah. Yeah.
Distributed gen. Next slide, please. Here, I think the technologies are not. I mean, they're fuel cells and small scale thermal. Distributed gen can be a lot of different types of assets. Those are a couple that we've highlighted. And really, the story here is that there's more of an ability to aggregate load, I would say, than there's ever been for a variety of reasons, including that the technology is much easier to integrate at this point. So we're starting to see large-scale acquisitions in this space, big players coming in and taking on distributed gen companies. NL and NG came in and made some big acquisitions. There's other companies that perform similar functions in the market that are trading. So we do see that there is strategic interest as well as private equity interest in the space. And I think this just generally suggests that there's a view that the grid will become more distributed and that some of these technologies in specific roles have a significant role to play. So from our perspective on the financing side, how do you handle large portfolios and different credits?
Yeah. I mean, just to emphasize the point, I mean, when we talk about distributed generation, right? I mean, we're talking about a portfolio of not a specific technology, right? I mean, distributed generation can be all these small fuel cells or all these small solar farms or wind or even small tiny gas plants, right?
Right.
So it's more of a model.
And it's interesting to see how this will play out, because in certain markets, like in ERCOT, for example, where it's tough to get your head around building out 800 megawatts at a time, building out distributed load to capture peaks might be a better solution. It's just something to think about.
Yeah.
So we're seeing that type of model rolling out in the market.
Yeah, for financing these types of assets, just because each asset is so small in amount, I think the ideal financing solution is almost like a credit card. Like give these guys a credit card so they can go and finance these assets one at a time, and then they can kind of roll it all up when they're ready.
Yeah.
Right. And do one big lump sum portfolio financing.
That's an interesting play, and I think that comes into the next factor, to the next subsector as well. And we can flip over to the next slide on that point. Whether it's distributed gen or starting to get into efficiency, where it's even more of an issue because then the individual projects are even smaller. From what I see, the companies that are the most interesting are the ones that have a bit of a credit function within their own environment, within their company.
Okay.
So that they can do some pre-screening, they can do some assessment, they can take a look at credits and say, okay, we've done a lot of the work. To your point about giving them a credit card, you don't want to give your credit card and your sports card to your 16-year-old. You want to make sure that it's handled properly. And so having those types of controls in-house, I think that's a factor that sometimes may be underappreciated. But to the extent that any company can start to build that capability within their own ranks,
sure,
that helps from a lending standpoint.
That would make sense, yeah.
Yeah, so we're seeing some of that as well, where HVAC swaps, lighting retrofits, very large scale build outs and rollouts that are individually very small projects. So you take a look at a portfolio, you want some rigor in terms of how you create the portfolio and the underlying contracts. But from a financing standpoint, it's not practical to say, hey, we're going to review every project that comes in through this type of program. So we'd have to get more efficient about it.
Yeah, I mean, look, this is interesting, this whole energy efficiency. I know I haven't seen too many of them, but do you have a view on volumes, Ren? Like, what's this look like next year or two or three?
We're starting to see some, like I mentioned before, there were some companies trading hands that are in this space that I think are starting to grow. At least we're starting to see facilities in the range of 50, 75, 100 million in terms of funding requirement.
Okay.
So it's getting to the point now where we're dealing with the growth pattern, and we're at the earlier stages for some of these ventures and companies. But we are seeing the growth is there, And for example, if you take a look at HVAC swaps, a lot of that infrastructure nationwide is old. So there is a fundamental need. And
let's do one.
For those that can do it efficiently.
Let's do one.
I'm working on it.
All right.
Got some in the pipeline. So there we are. I think it's there. Mobility. Now,
next slide.
Yeah, next slide, please. So this one, I think this is one that Ralph holds dear to his heart, big EV fan. And I think in general that this is going to be a big space. We look at it from a PF standpoint and say, okay, can we support the early build out, likely with respect to public transport and fleets and entities that have multiple vehicles that they're looking to charge and need to build out the infrastructure to support it. That starts to look more like a traditional project type deal where you've got a counterparty that needs the asset and is looking to service a fleet. We think there's opportunity in terms of all of the areas that we've outlined. It's still fairly early, but the point I would make is if you look forward to about 2025, that's the projection where there's parity on an automotive market in terms of gasoline versus EV, and then start to work backwards and say, okay, well, where's the build out going to start before we get to that point where the mass market starts to adopt?
Yeah, Brent, you know me. I'm a big believer of EV vehicles. Just like, the tube TV transformed to flat panel overnight. I mean, I think we're going to see that with electric vehicles, and who knows, maybe 3 to 5 years. I think you're going to see more and more switch over to electric vehicles. And to make that happen, I mean, a lot of infrastructure has to get changed. And right now, if you think about how many gas stations there are in the U.S., I mean, they've got a lot of wood to chop to put in the EV infrastructure for charging stations. So this is certainly an area I think we should definitely focus on. The question is really, it's more equity dollars right now than debt dollars, and so it needs to get to the point where we can structure in more debt dollars.
It's a scale issue at this point. Question is, how early in the game do you want to invest and can you invest as an institution? What's the risk profile and risk appetite?
Yeah.
But in terms of builds, I think there's certainly going to be a lot of activity in the space, and looking forward as far as planning for a team and planning for capital allocations and capital resources, what mix do you need as an institution? Certainly something to keep in mind.
Yeah, that's cool.
Next slide, please. Speaking of capital mix, I'll pass this one over to Ralph. This is just an outline of, again, the evolution more on the financing side and sources of capital and how the market will need to adapt.
Yeah, I mean, look, I think of, when you look at all the debt players that are out there, I think of everything as a giant jigsaw puzzle, right? I mean, you have some guys that want super safe loans, and they're willing to accept the low rate of return. And then you have some guys that are willing to take a little bit more risk, and they want a little bit more yield, and then so forth. So when we structure deals, we can tranche it out, or we can look at the credit profile and try to put something that works for the borrower, and we structure for something that we think would be appealing to a lender. And when we're talking about these emerging asset classes, I guess what I want to say is that there's something for everybody. At least Investec's we're in a unique position that we can lend across the capital stack. But you have different players that focus on different areas. So I think what we've laid out here is just to kind of show you high grade infrastructure at the top. That's going to be your safest. If we have a contract, if you can show some stable level of revenue that lenders can hang their hat on, you can create a debt profile that relies on this, and that's going to be your cheapest cost of capital. This whole middle tier is going to be for more, call it more aggressive banks, maybe some debt funds that are willing to add on some leverage and take on a little bit higher risk profile, and they want to get paid for that yield. And it goes so forth all the way down to equity. So for all these asset classes that we've been talking about, the more proven the technology and the more stable the revenues look like, we have put in tranches of bank debt, and then layered it on in case the borrower wants higher levels of leverage in their projects. We've layered on some of these, so it doesn't have to just be one. Is the point, right? We can layer on one or two or three of these levels of leverage. So I guess that would be the message for everyone who's looking to potentially finance these assets.
Yeah, generally the industry is going to have to adapt, and I think in terms of liquidity, there's plenty. I agree with that, Ralph. It's just what flavor does it come in, and how do you fit it into the structure?
Yeah.
Next slide, please. So just to sum it all up, we do see a major shift in sources and business models in terms of how the generation mix is going to evolve. In general, development activity is getting closer to the load, which suggests a more distributed model, larger portfolios of smaller assets. Revenue profiles are becoming more variable for a variety of reasons. I think generally we've looked at the continuing significance of natural gas in the mix, and a lot of that is being done on a quasi-merchant basis. But then as new assets come in, we're starting to look at C&I credits and different types of revenue profiles, which we also have to take into account. Counterparties are becoming more diverse on a similar point, and we'll need a more flexible capital toolkit to make it all come together. Solution, or the bottom line is, we won't be bored.
I like that. Future won't be boring. No, that's for sure. One thing I like about this business is that because of all the changes that are continuously happening in our sector, it's certainly very dynamic. And even with the lenders out there, it's super dynamic of who's coming in and out of the market. So yeah, I think it's definitely an exciting time to be in this industry.
Well, that's it for the presentation. We did leave some time for Q&A. If there are any questions, we're happy to take them on.
All right. I have one question here. Are investors showing a real interest in emerging power assets?
I would say a profound yes. Right now, as I mentioned, there's a supply-demand imbalance. There's a lot of liquidity out there chasing a small number of deals, and I can tell you a lot of deals have already been done this year. The volumes, I think, for the first 3 quarters of this year have been in excess of like $60 billion. Just to kind of put that in a frame of reference for you, last year of 2017, all by itself, it was probably about $50 billion. So we've already exceeded volumes in 2017. So there's a lot of capital out there chasing projects. So emerging power assets is interesting, which is why we are involved on this, is because everyone's always looking for the next big thing, and even from a diversification of your portfolio perspective, it's a good thing to look at different asset classes. And so yeah, I mean, everyone talks about it, but we just don't have the volume there yet.
Thank you so much, Ralph. I have a question here from Noel, and they're asking, is carbon tax coming, and do you know if that will change things? There's some bills floating around.
As far as whether a carbon tax will make it, that's hard for us to predict. There's certainly a major push to make that happen. To the extent that it does, I think it's pretty clear when you look at the profile of the market and how significant a role natural gas is playing and will continue to play. So to the extent that a carbon tax comes in, we would expect that natural gas fired generation becomes more expensive, which means that power prices in general are likely to increase, at least in the short term, but that should open up opportunities for competing resources.
Thanks so much. I also have a question here. Do you think long-term PPAs will make a comeback if reserve margins become strained through decommissioning?
I can take that one. Well, it could happen, sure. If there's an issue with supply, we could certainly see that come back into the market. We could see long-term PPAs push through the market again, or maybe to support renewable generation. It's a possibility. We don't we personally aren't counting on that, and at least as an institution. And when you look at the gas-fired development, which is a lion's share of what's coming on the horizon, especially in terms of baseload, that definitely has been done without PPAs, and there haven't been PPAs required. There's been no lack of development in PJM. Ralph, you can attest to that and speak to that.
Yeah, I guess. I mean, look, what do PPAs do? It just gives certainty of cash, right? So if your reserve margins are thinning out, you basically, as a system operator, need to incent new developers to come into market and build assets. PPAs is just one way to do it. Another way to do it would be to offer higher capacity prices.
Right. And if we look at PJM as a model, to the extent other regions are looking at solutions, it certainly hasn't hampered development there. So would it be necessary? Probably not. Could it happen? Sure.
We have a really interesting question here from Andrea. She asks,
love interesting questions.
thank you. Why do you think there are so few deals in the battery storage space while the conversation on storage has been so popular?
You want to take that one?
I'm sure we'll both have something to say. Go ahead.
Okay. Well, the storage conversation, for a variety of reasons, I think there's certainly a recognition that as we build up more renewable resources, to get the full bang from those resources, storage would be very useful on the grid to be able to take on, let's say, off-peak wind and solar, and be able to maximize the grid, the contribution to the grid of renewable resources. So on a functional level, there's an understanding that it makes sense. Now, in terms of regulation, in terms of incentives, that's a whole different story. So while we appreciate that there's value, or there could be value, at the same time, the regulatory regime and some of the incentives are lagging. And so that's the mismatch that we see right now. I think ultimately it'll happen. It's just a matter of timing.
Look, there's three types of applications for UC storage. You can either A, have it on a standalone basis, B, you can combine it with another generation asset like a solar or a thermal gas asset, or C, you can put the storage like the battery into an application, like we've seen it in some kind of vehicle like buses or forklifts or some other crazy application like that. Generally they're small, and if they're small, they get taken out. I mean, there's no widely syndicated deal. So number one, I don't know who tracks this stuff, but I think if someone did track, and I've seen statistics on this, I mean, there are storage deals out there, but as I was telling you, they're so small, and when they do come out, they usually get financed by one guy. Yeah. And so these are private deals. The stuff that gets tracked are the larger ones, and we do track the larger ones. There just haven't been a lot for lenders to kind of sink their teeth into.
The other factor is costs. Battery prices have come down quite a bit over the last couple of years, and they continue to drop. As I said, some of that is driven by EV ramp up. Some of that is just driven by efficiencies and technology. So as those resources get cheaper, all of a sudden now that conversation starts to become much more viable. So all of these things are happening real time.
But just to be clear, we've seen a number of RFPs come through, and sometimes there's just capacity plays, and so it doesn't make sense for many institutions to lend to it because it's very cheap financing.
We're just going to take a couple more questions. I have a question here from Brandy, and they'd like to go back to the previous question on long-term PPAs. Per our previous question on the PPA comeback, can you explain your rationale for equating higher capacity pricing to be an equivalent to the revenue security that a PPA provides?
Sure. So just to clarify, what a PPA does to an owner of a power plant, just so we're all on the same page, is it assures them some level of cash, so they know that they pre-sold their power. Okay, so that's what incents a builder to build an asset, because they know that they're going to make money and make a return on the equity that they invest. The other way that they can be assured some cash flow is capacity prices. So certain regions, let's say the most popular one like PJM, will tell, if you qualify, they will guarantee you a certain level of cash for your capacity, and they determine this 3 years out. So if you bid in, call it 100 megawatts, you know you're going to get paid just for having the capacity available into the market, a certain amount of cash. And when PJM lifts the capacity price for qualifying plants, it's a signal to the market that they want to incent developers to come and build megawatts, that they need those megawatts. Now, it's not a perfect solution because it doesn't guarantee you long term, but it is certainly a strong indication that your asset would be valuable in that region. The only problem is that it's like it could be a gold rush, right? Like the PJM might lift their capacity price 1 year, and then you have tons of developers come out and put assets out, and then what's going to happen is it could fall because they don't need so much. But it's a two-way sword, double-edged sword.
Yeah, I think one of the distinctions we should make, those are all great points. We've been able to crack the code in terms of merchant gas-fired generation. And so if a regulator and the governing body doesn't need to sign long-term PPAs and pass that on to their rate base, then they won't. And they'll probably save some money that way for the ratepayers. Now, making the distinction for renewables, that's still to be tested. Right? Can we get renewables done without long-term PPAs? That's still something that, the gas-fired market is much further ahead. The renewables market is still trying to figure that out. Can we get there? It's all to be seen. But generally, if there's no need for a long-term PPA, then we probably won't see them.
Thank you guys so much. This is my last question to you guys. Will we come to a point where traditional project finance, i.e. investment grade off-takers, long-term contracts, stable cash flows, will we come to a point where they will play a very limited role in the power market?
That's interesting. Look, anything's possible. My vote is it's unlikely, and trust me, we are not a player that plays just in fully contracted assets. I think there's a place for everybody. I mean, there's going to be a need for someone who wants the power on a long-term basis. A regulated utility, if he's short power, he may enter into a PPA. Definitely, right now we see a lot of merchant plants being built, and PJM has been a huge area for this. But do I see PPAs going away? I mean, I don't think so. I don't know what you think, Ren.
Yeah, I don't see them going away. I think just in general, I think in terms of orientation, we just have to be, as an industry, prepared to do things other than PPA financing, right? That'll be part of the mix, but we're going to start to see a lot of different revenue profiles. And if you want to capture the full market,
yeah,
there's a lot of opportunity there.
I mean, look, there's so many players out there, and everybody has a different business model, right? Some people are risk averse, and some people are risk on. And so, depending on what you're looking for, if you're risk on, you might build a power plant and decide to roll the dice and see where the power prices take you. But other guys won't do that unless they can be assured some kind of return. So I think the market is so deep and so wide, I don't see PPAs disappearing.
No,
Thank you guys. Oh, sorry.
Yeah, sort of thing.
Yeah, the counterparties could be different. And just to be clear, it's not just investment grade off takers. I mean, we see sub-investment grade off takers, we see corporate off takers, we see municipalities that might not have a rating. I mean, there's a lot of different people out there that could be a counterparty to a PPA or even a hedge, which is not mentioned here, but yes.
Yeah, we'll just see. We're expecting a market where the standard utility PPA is not the only way to get a project done. There's going to be a lot of different combinations.
Yep.
I think that's a great place to end. I just want to say thank you so much to both you, Ralph and Ren, for your excellent presentation and for answering all of our questions. And I want to say thank you to our attendees for joining our webinar today. Feel free to watch this webinar as many times as you like. You'll receive a recording of this webinar within 24 hours. And we hope to see you guys at our upcoming summit, Projects and Money, which will be in early January in New Orleans. and check it out at infocastinc.com/event. Thank you guys so much again, and I hope you guys have a great day, and see you next time.
All right. Thank you,
Thanks,
everyone.
Catherine.
Bye-bye.
Bye.